Don't spend 40 years of your earning time just shoveling into a safe of gold or a crypto theory that separates the fiat system and miss the fact that you're still day-to-day transacting in dollars. 1 in every 3 workers doesn't make it to the average retirement age of 65. I have a 1 in 3 chance of dying before age 65. If that's the case, failure to safeguard dependents against the loss of current income from personal or earnings is little short of a crime. Life insurance is the opposite of gambling. Its purpose is to... Hey everybody, what's up? Welcome back to Remnant's Finance Podcast solo episode today. Brian is officially over there now. So I'm going to be solo episodes as well as interviews where I can line them up here until he gets back, which right now is uncertain. So we're going to just continue to plug along. I've got a really exciting interview coming up. I'm going to talk to Zach Geist again. We talked about student loans last time, and if you listen to that one, I was really eager to not talk about student loans because even though that's his business, that's the company, and that's the value that I think is we can provide for our clients who have federal student loans is to dive into that. I think that's best suited by hopping on their calendar, exploring if that's the strategy that they implement works for you. But I really wanted to keep talking with him about economics and about kind of the philosophy of money. So we realized we had a similar author in common that most people don't read or haven't heard of, and when I mentioned a book by him, I ended up actually have 5 books on the shelf behind me, and he said I haven't met anybody who actually even knows who this is, Michael Hudson, let alone has the book. So we had a few other books that we were like connected on. He recommended one to me called Sacred Economics. I'm reading through that right now, and I am excited in a couple weeks to have him back on. We're going to talk about the philosophy of money, what it can be, what it is now, and where there's a disconnect there. So really looking forward to calls like that, because I think that we hammer the concepts that we talk about over and over, and I think that's good. I think the repetition is valuable. There's a lot of great IBC podcasts out there. There's only so much IBC specific material that we can cover, but again, like the same 40 or so concepts I think should be heard on repeat over and over, because one thing that's common is people get a policy, they get excited, they understand it, they're ready to go. A year goes by, 2 years goes by, and then they're like kind of, if you're not living it and thinking through it and studying it every day, inherently that's going to slip. And so get some calls like, hey, can we just do a refresher? Can you just walk me through how do I use a policy loan? What is my base premium? Just stuff like that is kind of like second nature to us studying it every day. If you're not in it and learning it and using it, then it's natural to have questions. So I'll say that if that's you, if you have a policy, you at one point could understand exactly all the mechanics of it, the elements of your premium, why you got what you got, but now you're kind of a little fuzzy on the details, and you were like, hey, I'm paying these big premiums. Why? What am I doing this for again? We want to hop on a call and have that conversation with you just to do that refresher and kind of dust off the knowledge there. So, but all that to say, I really like the philosophy of money. I like macroeconomics and thinking mostly about how we can optimize within the system that we are born into. I did a call recently with someone who is a pretty big hot podcast host and has a lot of guests that understand the fractional reserve system, the peril of that system, that kind of fiat money's fake, et cetera, and are looking for alternatives. A lot of people that understand the equity system, using the lawful remedies to get out of taxes, or that world, right? And that's a really intriguing world, and I've listened to a lot of Brandon Joe Williams, Cal Washington, people that dive into that world deeply and understand the difference between your all caps names and your corporate identity with the state versus who you actually are as a man, a lot of that stuff. But at the end of the day, I think our role is optimizing within the dollar system. I don't think the dollar system's going away. I don't think we're ever going to not have a fiat system. And the more I'm refreshing on some of the books that I read in the past that really got me interested in these concepts initially, in preparation for hopefully soon that interview, that follow up with Zach talking about the philosophy of money and Sacred Economics, that book, like some of these concepts, the more I read that, it's like you learn more and more about how fake the money system is, and at the same time, it reinforces my belief that it's not going anywhere, and that it's almost necessary in the global economy that we have. It's like we can talk all day about what should be and what could be, and yeah, if we had a small community, we could implement a more fair system and sound money and all that. But at the end of the day, like we're not, unless the United States dissolves, we're going to be using dollars, and so my job is to optimize those for my family. My job is to understand where the perils are and then understand where the risk is and what exposure I'm accepting by dealing in this world. But I want for my family, and I want for your family, that as long as you are being transacting in dollars, being paid dollars, and then if dollars were to go away, which I do not believe they are, despite all the economic fear porn that you can find, I don't think dollars are going away. And if they were, it would be replaced by something else that the government would accept for taxes and essentially getting back to the basis of a money system. Then that's what our units of accounts would switch over to that. So all that to say, I want to optimize our dollars, and I want to think through how we can be the best possible stewards, because all we get is this one shot. It's like, don't spend 40 years of your earning time just shoveling into a safe of gold, or, like a crypto theory that separates, the fiat system or something, and miss the fact that you're still day-to-day transacting in dollars. And so I think that having exposure to these different things is smart. But I think that if you want to optimize dollars, you need to study the system and know it, and you need to learn the trappings of it while still recognizing that your employer is still going to pay you in dollars, and you are still going to go to the grocery store and buy things in dollars. And even if you have your own homestead and you're growing your own groceries, well, you'll need to go purchase fencing materials or home upgrades or a solar system or whatever. It's all going to be transacting in dollars. And so with that in mind, I'm going to revisit a few concepts from back in the early days of our podcast, which is coming up on 2 years now. I think this is episode 94. So maybe a couple months out from 2 years, but a lot of our listeners probably haven't gone back to the very beginning and listened to all those. I mean, I think it would behoove you to do so, just to continuously hear these concepts. But some of the stuff that, we put it out there, it's in the top, or the early 15, 20 or so podcasts. It's like, and in my mind, we've put that information out there. And so if you listen to the podcast, you listen to that. But I know that when you pick up a new podcast, you don't typically just go back to episode 1, unless it's very early on. And so if you haven't gone back and listened to some of those, we're going to talk about a little snippet from a book called The Economics of Life Insurance. It's by Solomon Huebner. This was a 100-year-old book or so, maybe 80 years old, but you can see on here the $1 price tag, which is great because I paid 100 plus times that for this book. It's hard to find now. But this kind of set in motion the idea of the economics of life insurance, hence the title. It's beyond simply the fact that we are just providing some protection. When we think about life insurance, people just think, I turn some premium dollars now into more dollars for my wife later down the road. It's kind of a simple, let's just give this nice little gift for when I pass. The majority of policies, I think, are pieces of paper in a drawer without any thought to the living benefits. Of course, that is our wheelhouse. That is what we eat and breathe at Remnant Finance, is the power of whole life. And so what we're going to talk about today is the 3 forms of economic death that Solomon Huebner lays out in the first chapter of The Economics of Life Insurance. So you can go back to maybe episode 15, 18, something like that, and we have a conversation on this same section. But especially now that it's just me, I'm gonna kind of rehash some of these things that we might not have touched in over a year, just so for new listeners, and also for those who have already heard it, to just kind of reinforce with the effort of continuously learning and relearning and reinforcing what you know. Okay, life insurance guarantees dependence against loss of the current earning power of the insured through death in any of its forms. So when I talk, I'm just going to talk in the first person, talk about me as the income producer for my family, as the provider, as the breadwinner. And so how could what risks does my family have that life insurance can help protect against? So I'll read the first section of it because I think the whole thing is it's a very well-written book. It's written as if it's 80 years old. And so it's just a very kind of powerful writing here, in my opinion. I'm not sure the best way to say that, but he says, just as property is subject to destruction by fire, marine, and other perils, and to loss through legal liability for negligence, so the monetary worth of the human life is constantly subject to destruction by loss of current earning power through death or through serious diminution, through temporary disability occasioned by sickness or accident. Viewed as a contract, life insurance simply involves the promise of the payment of a specified sum by one party, known as the insurer, to another party, the insured, or his designated beneficiary, upon the payment of a stipulated consideration, the premium, and subject to contract conditions. This legal definition, however, does not reveal the great underlying economic purposes of the institution of life insurance. So that's what I was just saying before, how most people think of it. I pay some money now, somebody else gets money in the future. Yeah, of course I want to protect that somebody else in the future, but it doesn't really do anything for me right now. It's just, we're just delaying this payout, which, yeah, that'll help, but no one's excited about that, other than like out of a sense of duty and moral obligation, which I would argue is more important than the living benefits that we actually do get excited about. And we'll get into that duty more. One of its primary purposes is to guarantee dependence against loss of the current earnings power of the insured through death in any of its forms. So here we're going to get into 3 types of economic deaths beyond just what we think of with death. I die, I'm no longer here, right? The life insurance actually pays out. We are so apt to construe death only in the light of the casket variety, actual physical death, whereas the concept needs to be given an economic interpretation. Life insurance exists to serve mankind economically, and it is short-sighted to insist upon a technical construction. Aside from the temporary disabilities, its broad mission is to protect against the total and presumably permanent loss of current earning capacity when that loss is occasioned by the economic destruction of the insured life. All right, just read that. I'm going to read that one more time. Broad mission is to protect against the total and presumably permanent loss of current earning capacity when that loss is occasioned by the economic destruction of the insured life. So we have, as he'll lay out, three different ways that you can have the total and presumably permanent loss of the current earning capacity. And only one of those is when you're actually in the ground. The other two are going to be a disability while you're alive, and then retirement. One of those is unplanned, one of those is usually planned, but the outcome as far as your income is the same. The important thing is that the working life has died as an income producer, and that particular form that the death assumed is relatively unimportant. So your income dies with you. Again, when we talk about life insurance and the death benefit, we are insuring your income. We are protecting your assets, one of your assets while you're working being the income that you earn, your ability to earn income. When we talk about you are your most valuable asset, your ability to go out into the workforce and reliably produce X amount of dollars annually for your family, that's your greatest asset for almost everyone we talk to. So that's what we're actually protecting. We're protecting that income. We're not just, life insurance it's not even the best term for it. It's income insurance. It's income protection. And so we can lose that income. We can have an income death in more ways than just ending up in the ground. The important thing is that the working life has died as an income producer, and the particular form that the death assumed is relatively unimportant. From an economic standpoint, death may take any one of 3 forms. 1, physical death. 2, living death. 3, retirement death. So for that physical death, actual premature death during the working period of life. This hazard is many times as significant financially and many times as great in its striking power as is the hazard of fire with respect to property. All life values are subject at all times to this risk, whereas only about half of the nation's property values, despite the fact that they are much smaller than the aggregate of life values, are subject to the fire hazard. The overwhelming majority of buildings never burn, while about 1 of every 3 workers at age 30 dies before the retirement age of 65 is reached. Now, these stats are old, so I'm going to use the stats here. They're going to be different, but the magnitude of them is the same. So to think through that, have you ever totaled a car in your life? Some of you certainly have. I haven't. I'd say more people listening have not totaled a car than have totaled a car. But how many of you have car insurance and replacement insurance on your current vehicle? I would say 100% of you have insurance on your vehicle, and most have full replacement value. Same thing on your home. Depending on where you live, you don't need fire insurance. Out here in San Diego, you definitely need fire insurance, earthquake insurance, right? You have to have those as part of your either renters or homeowners insurance. But most people have never had a home burn down. If you haven't had a home burn down, you're probably in company with about 99% of the audience. I know that Joe Withrow's brother had his home burned down. That's a very rare instance, yet people have insurance against that. At this time, it was half of the nation's property value. So again, the overwhelming majority of buildings never burn, while about 1 in every 3 workers at age 30 dies before the retirement age of 65 is reached. So just assuming that's the same, assuming those numbers still hold, and of course they're going to be different, I'd argue we have longer lifespan, but we're also less healthy. So who knows where the actual numbers are right now? I intentionally didn't dive too much into current mortality statistics or trying to find an updated version of that stat, because I think just the concept speaks for itself. I'm 37. If we hold that to be the same, that 1 in every 3 workers doesn't make it to the average retirement age of 65, I have a 1 in 3 chance of dying before age 65. If that's the case, that's an enormous probability. Like if you knew that there was every single day of the 10,000 flights that depart and land in the U.S., one of them wasn't going to land, the amount of people flying would plummet. If there was one plane crash a day, then nobody would fly. People would be done with the airlines like forever, right? If there was a 1 in 100 chance, there wouldn't be any, again, there would be no airlines at all. We're talking about a 1 in 3 chance you're not going to make it until the retirement age, which means your income is going to pass with you. Do you have a provision in place to where if your income dies prematurely before your retirement age, because that's that third type of death is retirement, income death. Your economic death in retirement is when you're intentionally pulling the plugs on your earnings. Now, retirement strategy hinges on getting all the pieces in place so that you can pull the plug on your income and continue to sustain yourself. But that is clearly not, that plan has not worked. If we look at the average retiree, or even I'd say probably 80% of retirees, that plan has not worked. But regardless, that is at least the intention, that you pull the plug on that income. But if that plug is pulled for you before you're ready, if you haven't had time to build up that estate for yourself or those you leave behind, that's a 1 in 3 chance. There's not much that we would, if we had a 1 in 3 chance of the event playing out, that we wouldn't insure against. Like if 1 in 3 people total their car, the cost of totaling car insurance, or the cost of car insurance, would explode, right? I don't know what the number is, how many in 1 in however many actually total their car, but I'm confident it's not 1 in 3. And so the fact that we can, if we qualify financially and medically for this product, get this protection here, and the fact that we can do it to our full human life value is a really powerful and I think critical tool that we should all have. When fire occurs, the loss to the property involved, on average in well-protected cities, is only a partial one, whereas premature death always means a total loss of the current earning capacity of the individual. Moreover, as will be explained later, death of the owner of an existing property estate, irrespective of the character of the property, nearly always means a substantial shrinkage, on the average between 20 and 25%, or greatly in excess of the average fire loss of about 10% of the property involved in the fire, in the value of that estate through social and legal demands in the form of unsettled obligations. So he's saying that very few people's house actually burns down, but almost half of the homes in America have fire insurance at this time. When a fire does occur, it on average burns only 10% of the house. Yet when you die, which we all will, with 100% certainty, the loss is permanent and total 100%, so far as our income goes and so far as our time on earth goes. And so we have this guaranteed event of our death, 100% certainty. And when that happens, it's a 100% loss of our income. And yet we insure that risk to a fraction of the degree that we insure something like fire, which has a 10% destruction rate. And half of the people in the country actually have that coverage. Okay, so going back to what's actually lost in the estate. When you die and you lose your estate, your income is gone by 100%, and then you have unsettled obligation, last illness and funeral expenses, estate settlement costs, post-mortem taxes, and there wasn't estate tax at the time. Now there's estate tax, so depending on how many assets you leave behind, you could be looking at 40+% of everything over $30 million now for a married couple. So the exemption rate is very high on that, but that's also another factor. The capitalized worth of the earning power of life, when properly appraised, is an economic asset just as truly as is appraised property. If we choose to apply indemnity contracts to our property possessions, it follows even more logically that we should be equally sensible with the monetary worth of our lives, especially since that value constitutes the only real business worth there is for the overwhelming majority of family heads, 95%. All right, let's talk through that. If you choose to indemnify or insure your property possessions, it is equally sensible that the monetary worth of your life should also be fully insured, especially since for most people, he's saying here, that is the only, or at least the largest, asset that you have. How many people don't have assets? The only asset they have is their ability to give. I mean, that is like the middle, maybe lower middle class and lower class. Like, the only asset you might have is your ability to wake up, get out of bed, and go work and earn enough for subsistence, for survival, right? So this is your most important asset, and this is the one that is left uninsured, unprotected. I'm going to read this one more time because it's that important. The capitalized worth of the earning power of life, when properly appraised, is an economic asset just as truly as is appraised property. If we choose to apply indemnity contracts, insurance, to our property possessions, it follows even more logically that we should be equally sensible with the monetary worths of our lives, especially since that value constitutes the only real business worth there is for the overwhelming majority of family heads, the 95%. Not only is that value intimately associated with business success when there is substantial property, as will be explained later, but in the absence of such property, i.e. your life, it clearly constitutes the financial foundation of the home. Okay. That's the first type of death, the casket death, the type we're all familiar with. That is a 100% certainty that's going to happen for you. And so it is the most sure outcome here. It's the thing that we want to guarantee protect events. All right, the next one we want to talk about is the total and presumably permanent disability, a living death within the working period of life. I would argue this is the most costly of these three outcomes: retirement, full casket death, or this disability, because you are still alive and have resource needs and the income is not there. Although not dead in the casket sense, the life has nevertheless disappeared as a working force for dependents or business associates. Rendered useless as a productive force, that is, amounting to obsolescence under accounting terminology, the life still lingers as a consumer only and as a cause of heavy expense to dependents through medical or special maintenance, often over a long period of time, eating up even the limited family resources that may have been accumulated. Clearly, this type is the most terrible of all forms of death, and the frequency of its occurrence is by no means small. We are told that the risk of becoming disabled before age 60 and continuing in this condition for at least 2 years is several times as great as the chance of death from accident before age 60. In fact, the chance of becoming disabled before age 60 and remaining so for at least 10 years is nearly as great as the probability of death before age 60 from such an important cause as heart disease. And this is back before heart disease was off the charts, a killer as it is today. So becoming disabled before age 60 and continuing that for a few years is several times as great as the chance of dying before age 60. But then the longer you have that disability for, the fewer instances that is the case. And so you have to go out to 10 years to drop down your probability as that of dying early. So you have the exact same chance back then of getting disabled and being disabled for 10 years as you did of dying early. And so, like he said, this is the most terrible forms of death. I think we could all argue that we would rather have our loved ones in this state than not here at all, unless they're in so much pain that it's just a release for them to just, their time on earth is up. They're moving on, and it's like you're sad, but you're ready for their suffering to end. Outside of that situation, I would still rather like have, my wife or child in a wheelchair and disabled, or me disabled, but still be around with my family. I would rather have that than dying early. But as far as if we're just stripping it down to pure economics here, not only are you pulling the plug on the income in this situation, but you're also not decreasing correspondingly the resources that you are going to consume, right? According to Robert Brown Jr.'s figures, about 1 in every 9 persons between 35 and 65 may expect to become totally and permanently disabled. Clearly, such a serious risk producing economic death of the human life value needs to be guarded against, especially when there is a dependent household at stake, by affecting insurance that will not only guarantee an income during the period of total disability, but will also relieve the disabled insured of the responsibility of continuing premium payments on its physical casket death life insurance, so that it may be kept fully intact for the purposes of the family when the living death finally becomes an actual death. So here he's talking about the waiver premium rider, I believe, at least in part. That is the rider that if you qualify for it, I think it's worth having, to where if you get disabled and are unable to earn income, the company will pay your premium for you. What other assets do you have where if you stop earning due to a disability, contributions will continue? If you have a savings account and you're saving money, or a brokerage account and you're investing money, or you're putting money into your real estate business, if that income stops coming into you, the income is going to stop going into those assets. This is the one asset where you can get a rider that will make sure the payments into it continue to preserve that death benefit for your estate, even if you are not able to work and earn. That's not everyone qualifies for that. A lot of our military, just by nature of their job, don't qualify for the waiver premium rider. We always apply for it, and hopefully we get it. If we get it for a client and they want to implement it, I think it's a wise choice to do that, because we talk about IBC as kind of like shoring up your dam. If you have a lot of holes in the dam of your financial life, IBC plugs a lot of those holes, right? We talk about the attributes of whole life all the time. You plug a lot of holes in that dam. This is kind of like a big shield against a lot of those holes. But there's one hole in this, in the IBC strategy, is that you need to at least be able to make your base premium payments. And if you can't do that, then it all falls apart, because you're not able to keep that protection in place. And so having that rider is hugely valuable. That said, there is a more valuable tool for continuance of income in the event of a disability, and that would be disability insurance. I know Brian has been having conversations with someone who's in the disability insurance field, and hopefully have him on to talk about it. We also talked about long-term care with Travis McBride recently. Long-term care, disability insurance, this is all thinking in the protection mindset. Those are not products that just, you don't have the same power with those products as you do with cash value, where you have a full range of what you can do with it, how you can grow it and leverage it, etc. But having that protection in place is critical in the protect, save, grow framework. We're working on a client portal and kind of a financial analysis portal, which will be not financial advice, but you'll be able to upload documents that will be, you can basically build out a profile, and then you can play with I'm still designing the graphic here, but it's going to be an interactive graphic that puts this protect, save, grow framework into a visual, and you can kind of see the system, at least how it exists in my mind, rather than just hearing protect, save, grow, like actually seeing everything kind of laid out. And I think it's going to be a really cool graphic. But one of the risks there on the protection side is the risk of disability, or potentially becoming infirmed, having long-term care needs. And so the waiver premium rider is a valuable addition to this policy, and a unique one across any other financial asset that requires, or at least desires, a continuous feeding of input. If those can continue without you having to provide it, that is an enormous value. But I'd say More important than that is exploring disability insurance and then long-term care as you get closer to this third type of economic death, or retirement death. Back to the book. For many years, the living death hazard was regarded as belonging to the field of casualty insurance. Within recent years, however, the risk has been widely assumed by life insurance companies, and rightly so. The living death is a real economic death, and indemnification of loss occasioned thereby belongs logically to the field of life insurance. Total and permanent disability insurance, from an economic point of view, should be viewed as an annuity for the disabled victim for life, if the total and permanent disability occurs before the retirement age of 65. Recognition as an annuity has not yet been given to this type of coverage, but in due course, there will be an annuity program consisting of two types of life annuity coverages, namely, one, in the event of total and permanent disability before the retirement age of 65, and two, a retirement annuity for life beginning when the totally and permanently disabled insured reaches their retirement annuity age of 65. So that's, if you recall from our last discussion on annuities, the idea of putting in place, like I described the VA claim, without having to come up with $2.5 million, you can put in place a little, like a reservoir that will generate $4,000 a month of tax-free income for you. The cost of that, if you were to buy, quote, a money printer, as I like to describe it, that could generate that $4,000 of post-tax income, you would need to fund that with $2.5 million today. In the same way, if you look at your total annual premium, now we're talking base here, and your term rider, we're not talking about PUA, but if you look at your total base required premium, there is an amount of money you would need to pay as an investment to generate that amount post-tax. Well, by paying for the waiver of premium rider, if you qualify for it, you're effectively, for a smaller price than that, paying for the right to have that in the event that you do become disabled. All right, so we've covered the casket death, the disability death, and finally the retirement death at the age of retirement from active work. Here again, the life disappears as a working force, but still continues as a consumer. Age 65 is generally regarded as marking the end of the period that represents the average person's major earning capacity. Approximately 6 out of every 10 at age 25 will survive to the retirement age. When that age is reached, it's important that the retiring worker be financially self-sufficient so that the heavy financial burden of old age support may not be lodged upon his children, thus denying to them, as is now so often the case, their normal opportunities in life. So you don't want to become a burden on your child by forcing them to have to care for you when they are in a period of life where they're trying to raise their family. And if we add that burden, and back in his day, he's saying that most parents end up having to rely on their kids because they don't have this, either the retirement strategy, which at the time didn't really exist, the way we think of it today, but having built up that asset base to cover those expenses. We don't want to be a burden on our children. In fact, we want to do the opposite. We want to be a blessing to our children, and we want to leave an inheritance to our children's children. That's the game we're playing here. Life insurance, as will be explained in later chapters, is admirably designed to meet the insurer's desire for a decent competency at the age of retirement. Although at present, the average amount of life insurance cash values per American family is only about $1,400. That's obviously you know what? I wouldn't be surprised if that's actually kind of accurate, since very few have life insurance now who have whole life that actually understand it. So for our clients, that is very inaccurate. Their cash value is much higher than that. But I would say that funny enough, because back then, at this point, everyone had whole life insurance. That was the main savings vehicle. And so $1,400 of 1930s money for the average cash value, when everyone has it, it might not be that much different than today when most people don't have it. On the one hand, that cash value guarantees a potential estate in the event of premature death, i.e. that cash value materializes into the full death benefit in the event of premature death during the working years of life. While in the event of survival to the end of their working period, its accumulated savings fund will furnish the means for old age financial protection. If desired, the insurance may be so arranged as to cause the savings fund to reach the full face value of the policy at any designated age. Moreover, in the interest of certainty and regularity of income, the insurance proceeds may be left at interest for investment with the insurance company, or may be converted into a life annuity for old age income purposes and the protection of the children against assumptions of the heavy burden of parental financial support. Life insurance alone is available for the protection of life value against the aforementioned three types of death and has no substitute. Not to insure adequately. This is heavy right here. If you're a father listening to this and you're not taking care of this hurts to hear. But I fully agree with it. Not to insure adequately through life insurance is to gamble with the greatest economic risk confronting man. If understood, the gamble is a peculiarly selfish one, since the blow, in the event that the gamble is lost, falls upon an innocent household whose economic welfare should have been the family head's first consideration. That hurts if you're trying to be a good husband and a good father, and you're working hard and you're accumulating assets and you're trying to think towards retirement, but you don't have this one aspect buttoned up, which for a lot of people is the case. That hits heavy, but I believe that this is our moral obligation, that we should be ensuring and protecting our human life value so that when we are gone, our income is able to continue producing for our wife and our children, whether we're here to earn it or not. I'm going to read that again because it is so important. Not to insure adequately through life insurance is to gamble with the greatest economic risk confronting man. If understood, the gamble is peculiarly selfish, since the blow, in the event the gamble is lost, falls upon an innocent household whose economic welfare should have been the family head's first consideration. Where business protection against the loss of life that gives managerial direction and success to businesses involved, the gamble is a needlessly foolish one, more foolish than the avoidance of fire, marine, or other forms of property insurance. But when the family welfare is concerned, especially in the absence of a large property estate, so if you don't have a large estate, if you don't have a lot of assets, which is most people, if you, the income earner, are the largest asset, which is almost everyone, and that ability to go work is pretty much all you have, in that case in particular, when the family welfare is concerned, especially in the absence of a large property estate, failure to safeguard dependents against the loss of current income from personal earnings is little short of a crime. Life insurance is the opposite of gambling. Its purpose is to create certainty for us out of the greatest uncertainty with which we are confronted. One of its primary objects is to guarantee a potential estate to those who may not be allowed the time to accumulate one themselves. And again, that's 1 in 3 people. That's, if you're 30 right now, 1 in 3 people that's not going to make it to retirement age. You're able to guarantee an estate where you don't have the time to otherwise accumulate it. From that standpoint, life insurance is in the last analysis is time insurance. Time is the most valuable asset to those who are not richly endowed with material goods. Property insurance protects the individual against the loss of property already in existence. Life insurance serves the same purpose, but it also does more. It protects the insured against the financial consequences that result from a loss of his time through premature death or the living death, by guaranteeing to him the full estate that he had resolved to accumulate but was prevented from accomplishing because of an untimely death. Again, life insurance serves the same purpose, but it also does more. It protects the insured against the financial consequences that result from a loss of time through premature death by guaranteeing to him the full estate that he had resolved to accumulate, but was prevented from completing because of an untimely death. Even assuming the presence of an apparently adequate estate, life insurance still serves as a factor of safety to meet emergencies. The best laid plans with respect to an estate are only too apt to go wrong, as will be demonstrated later. Engineers and conservative investment houses always make an allowance for a factor or margin of safety in order to meet the strain of unforeseen contingencies. At the time of death, important financial obligations usually remain to be settled. Our economic life is largely a speculation, and life insurance serves as a factor of safety to withstand the unusual financial strain upon the family business, i.e., what you do. Like a man has 2 businesses, right? The job that you do, how you earn income, and a banker. We talk about that all the time. Your family business is you running your family's economy. You need to be the CFO of your family. You need to stop being a passenger, as we say. Our economic life is largely a speculation, and life insurance serves as a factor of safety to withstand the unusual financial strain upon the family business should death occur at a time when the accumulation of an adequate estate has not been completed, or when the speculative elements in our business or vocational life may have turned out adversely. That's the end of that little section there. I want to bring that up again to expand your thinking on the purpose of what we're doing beyond just when I die, this will happen. Because yes, that will happen. You are going to leave your beneficiaries hopefully better off than you. If you're following our program and adequately ensuring your human life value and ensuring your wife's human life value and making sure that we're taking this step-by-step approach to build up your family bank, you are going to leave your children many, many, many times more wealthy than you are. With that, we need to provide the knowledge and the education there. But we can have the best laid plans, and if we don't make it, they could fall apart. So make sure that you're preparing for not only the casket death, also the disability death, which is the more costly form of economic death, and the retirement death. The Retirement Inc., that game is that it's you can't look any direction without finding advice on retirement, how to plan for it, etc. But you don't often see advice on how to prepare for disability in particular, or death. And the solution to a permanent problem, i.e. your death, is often a temporary measure, i.e. term. And that's a whole other episode, why buy term in the vested dividends is such a terrible strategy. But with that, just remember that you need to become the CFO of your family. Stop being a passenger in your financial life. All right. We'll be back next week. Hopefully get Zach Geist on soon, and I'll be doing some more of these kind of refresher episodes just on some of the more basic concepts, human life value, term, policy loans, stuff like that, just to kind of keep these concepts front of mind. So, all right, with that, we'll see you guys next week. Cheers.
Thanks for listening to Remnant Finance. If you found any value at all in this episode, please subscribe, leave a review, and share it with a friend.
Remember, true financial freedom comes from taking control of your personal economy and breaking free from the status quo. So stop being a passenger in your family's financial future.
Boldly take back control of your wealth. Until next time,
this is Brian and Hans signing off.